Right now, silver is sitting in a range, tight, boring to most people. But the structure underneath? Not calm, not even close. Industrial demand is ripping higher, geopolitical supply is narrowing, and the largest private silver hoarder on the planet, JPMorgan Chase, sitting on roughly 750 million ounces, just quietly flipped its futures positioning from suppressive to supportive. That's not a random detail. That's the valve opening. If you're stacking silver, watching it, or even ignoring it, you need this context, because calm prices are often the loudest warnings. And if you're watching now, before the crowd reacts, you're already ahead of the move. Your job isn't to predict when it breaks. Your job is to understand why it will. This isn't about hype. It's about patterns that repeat across decades. And by the end, you'll know exactly what to watch. This week, this month, to stay ahead. But the most important piece? That won't make sense until the very end. Let's go. Before we dive in, hit subscribe. Not because I'm chasing trades, because we're building a watch group. People who track flows, not headlines. People who see pressure building before it explodes. Now let's break down what's actually happening, layer by layer. For 15 years, JPMorgan quietly stacked physical silver, while the public narrative discouraged ownership, while talking heads called it a barbarous relic, or too volatile. While futures markets signaled nothing but calm abundance, JPMorgan accumulated, not millions of ounces, hundreds of millions, roughly 750 million ounces of physical metal. That's not speculation. It's documented through COMEX deliveries, vault reports, and regulatory filings. Now here's the contradiction. The largest silver holder in the world was also a key participant in price discovery, futures positioning, market making, the very mechanisms that influence how silver trades. And for most of those 15 years, their futures book leaned short, suppressive, capping upside, until recently. Now their positioning is flipped, net long, supportive. That's when the rules change. Think about that for a second. The player with the most to gain from low prices spent over a decade buying at those low prices. Now they're positioned to benefit from higher prices. They don't need to suppress anymore. They're done accumulating. Let me name this mechanism simply. The liquidity valve. Imagine a fire hose under pressure. As long as the valve stays closed, nothing explodes. Water builds, pressure rises, but it stays contained. Accumulation happens quietly in this phase. Once positioned, the valve opens. Not to cause chaos, just to stop preventing it. The market does what it wanted to do all along. We've seen this before. Oil in the early 2000s. Majors accumulated reserves while prices stayed subdued, then stepped back. Gold from 2001 to 2011. Central banks flipped from sellers to buyers, and the entire price regime shifted. Housing credit in 2006. Liquidity flowed freely until the big players pulled back, and the whole structure collapsed. The pattern repeats because the mechanism is timeless. Large players suppress volatility while accumulating, then remove downside pressure once positioned. Not telling you silver will explode tomorrow, showing you the structure that precedes moves. And here's why this matters. Price often moves last. The real action happens in positioning, in incentives, in who benefits from what outcome. By the time price screams, the informed money is already there. Now let's go deeper. Futures markets can signal abundance while physical markets tighten. This isn't theory, it's mechanics. COMEX has two inventory categories, eligible and registered. Eligible silver sits in warehouses but isn't available for immediate delivery. Registered silver is, and registered inventories have been draining unevenly, thin relative to open interest. Most futures traders never intend delivery. They roll contracts, they settle cash. The system works because most participants don't ask for metal, until someone does. Then the game changes, because if delivery demand rises and registered supply can't meet it, the market has to reprice, fast. At the same time, lease rates and physical premiums are staying sticky. Dealers paying more to secure metal, coin premiums holding elevated, delivery delays persisting. That's not noise. That's pressure. And here's the compounding factor, China. China's silver export controls are tightening, not headline-grabbing bans, quiet restrictions, licensing delays, bureaucratic friction. These don't spike price immediately. They shorten the fuse. Shortages don't announce themselves. They whisper. You see it in premiums first, then delays, then rationing, then, finally, price. We're in the whisper phase. So let me reframe this. For years, the question was, why is silver stuck? Wrong question. The real question is, if JPMorgan no longer benefits from low prices, who does? Think about the implications. If the largest holder has repositioned, if physical supply is tightening, if industrial demand is climbing, if geopolitical flows are narrowing, who's left holding short exposure? Who's counting on calm markets? Who's betting nothing changes? Not advice, pattern recognition. But this is how wealth transfers happen. Slowly, quietly. From inattentive holders to informed accumulators. And most people won't notice until the move is already over. Circle this. I don't know which path we take. Can't. But I can show you the map. First path, slow grind up. Controlled repricing. No chaos. Insiders win quietly. Price rises 10 to 15% over months. Premiums compress. Futures converge with physical. Retail chases late. Who benefits? Patient accumulators. Who gets trapped? Short sellers hoping for mean reversion. Second path, volatility shock. A supply headline drops. Export ban. Mine closure. Delivery failure. Thin liquidity meets sudden demand. Price gaps 20 to 30% overnight. Premiums explode. Stops get run. Who benefits? Those already positioned. Who gets trapped? Leveraged traders and late chasers. Third path, false breakdown. One final shakeout. Silver drops 8 to 12%. Headlines scream, collapse. Weak hands sell. Then, reversal. Sharp. Fast. Leaves sellers behind. Who benefits? Strong hands who bought the fear. Who gets trapped? Those who sold the dip. Could reverse. Could consolidate longer. Your job isn't to predict which path. It's to recognize the structure and prepare for asymmetry. Here's my watch list. These are the signals that tell you which path we're on. First, COMEX registered inventory changes. When it's normal, inventory drifts. Small fluctuations. Random. When there's stress, you see sharp one-directional draws. Persistent declines. Registered falling faster than eligible. What it means is delivery demand is real. Supply is thin. Second, silver lease rates. Normal looks flat, boring, near zero. Stress shows up as spikes, even small ones, 50 to 100 basis points. What it means is someone needs metal now. Tightness is spreading. Third, physical premiums on coins and bars. Normal means premiums fall when price is flat. Distribution phase. Stress means premiums rise despite flat price. Shortage. What it means is paper and physical are decoupling. Fourth, JPMorgan futures positioning. Normal means position shifts are common. Stress means net long persistence, holding supportive positioning across multiple reporting periods. What it means is the incentive structure has flipped. Fifth, China export policy signals. Normal is bureaucratic noise, minor delays. Stress is new restrictions. Licensing tightens. Flow data confirms reduction. What it means is the fuse just got shorter. There's also a risk cluster to respect. Spread behavior between futures months, miners diverging from metal price, volatility skew shifting toward calls, delivery notice volume rising. These don't predict, they confirm. If you're a trader, respect volatility and manage stops. If you're a long-term holder, accept pullbacks and focus on structure. If you're watching from the outside, now you know what insiders track. Not telling you to buy, showing you what to watch. Here's what most people miss. Markets don't move all at once. They move in waves. First wave, informed money positions quietly. Second wave, early observers notice the signals. Third wave, headlines confirm what already happened. Fourth wave, retail reacts. If you're watching flows instead of headlines, if you're tracking inventories, lease rates, positioning shifts, you're already in the second wave. You're ahead of the crowd that only reacts after the move. That's not luck. That's preparation. Comment below and tell me which signal are you watching most closely. Have premiums changed near you? Have you noticed delivery delays? I want to hear your experiences, because this community spots moves early when we share what we're seeing. And if you've caught moves before by watching these patterns, share that story. It helps others trust the process. Silver doesn't need hype. It needs attention. The structure is already there. The positioning is shifting. The supply is tightening. The only question is timing, and that's not something we control, but we can control our awareness, our preparation, our ability to recognize when pressure is building before it releases. Subscribe if you want to stay inside this watch group. Share this with someone who's stacking or trading silver, because the more people tracking these signals, the better we all see what's coming. Your job isn't to predict the move. It's to be ready when it happens. Not advice, just patterns. And these patterns, they repeat. See you in the next one. Comment watching if you're tracking silver this week.